My name's Tom Phillips. I'm the president of Effective Agreements, and I would like to thank you for attending our webinar, Common Problems when Structuring and Negotiating Agreements. The recording of this webinar is going to be divided into 3 parts, so they won't take up as much space, and so that the people who download it can listen to as much as they want to at a single sitting. Now, your first question probably should be, who is this guy Tom Phillips, and why in the world should we listen to him? As I said, I am the president and founder of Effective Agreements, and our task is helping small to medium-sized companies with their commercial agreements. Previous lives, I have 20 years of experience doing M&A work, strategic alliances, and major agreements. Started that off with LTV Corporation. Then I went to DSC Communications Corporation, where I spent 13 years. I was a vice president of corporate business development, and I was in charge of the M&A group. We did about $500 million worth of transactions, which back in those days was real money. And during that time, we also got tasked with doing a lot of the other kinds of major agreements that were strategic to the company. I spent a couple of years as vice president of business development of a startup called Teloptica, basically in charge of one of their funding rounds. And since then, I've had about 11 years of consulting with small to medium-sized companies on their agreements, and that's the topic of our webinar. So what we're going to talk about is common problems when companies structure their agreements. We're going to go through some specific problems that we've seen pretty frequently with the small to medium-sized companies, and hopefully some useful advice for avoiding them. The agenda for this portion: first, we're going to talk briefly about what are the aspects of a proper agreement process and how should it work, just sort of a base starting point. Then we're going to talk about the wrong person in charge. That's the first of the problems that I'll be discussing in this series of 3 portions of the webinar. And for it and for all the others, I'll give the impact of the problem, suggested solution for the problem, and some more stories that hopefully are interesting enough to keep your attention and make you able to enjoy what I've got to relate. So let's start off with what are the aspects of a proper agreement process. Well, the first one I see is that it should run smoothly without constant management intervention. Well, that sounds a little simplistic and a little obvious, but it's really not. An awful lot of the small to medium-sized companies I run into, the management team is still very much caught up with running the day-to-day process of getting these agreements done. And I'll talk about the problems that can cause a little later, but it obviously is an aspect of their taking their eyes off the core business. The agreement process should be cost-effective. By that I mean the professional fees should align with the value of the transaction. If you find that you're having to spend an awful lot of money on attorneys, maybe on accountants too, but you're doing it for very small sales agreements or something, you need to consider if you're doing something that's kind of out of kilter. Obviously, the costs should not be so much that it makes it a losing proposition to finally get the deal done. When you're doing that, though, don't forget to take those internal costs that you're going to incur into consideration as well. You've got the management team and whoever's working on the contracts, and every bit of time that they spend working on those contracts is an internal expense to you. And finally, we feel that the resulting agreement should be effective for its purpose and protect against risk. Again, 2 things that sound very simplistic and intuitively obvious, if you will, but that I run into exceptions all the time. Many of the agreements I see are really not effective for their purpose because they don't quite say what it is they're supposed to say. They're effective for something very close to the purpose, perhaps, but they kind of miss the mark. There's also some of the time the problem of more than they should be doing. In other words, for example, I ran into a non-disclosure agreement recently. It was sent by a large company to a small client of mine, and in the middle of the non-disclosure agreement was language that would have sucked up all of the smaller companies' intellectual property rights in the finished product. That wasn't right, and that's an example of where you had an agreement was more than effective, I guess, for its purposes, but it really didn't do what it needed to do, just take care of the non-disclosure part of it. And then the protection against risk, a lot of that's going to be the attorney's part, but obviously there are a lot of commercial aspects that are risk. So what's the reality? Reality is many companies fail to meet these criteria when they're working on their agreements. And I'm talking about not only your basic commercial agreements, but strategic alliances, acquisitions, divestitures, all the way up into those higher level agreements. So let's talk about the first problem that we see and look out for, and that's the person in charge. Most of these small to medium-sized companies don't have a full-time, experienced contract or business development type person on board. They're not large enough, they can't afford a person like that full-time, so they don't have them. That being the case, who does managing the contract process fall to? Well, usually it's the senior management team, and for some reason, it usually seems to be the CFO. Not exactly sure why. Other than that, it falls to what I refer to as an inexperienced subject matter expert. Obviously, I don't mean somebody inexperienced in their subject matter. I mean somebody inexperienced in doing contracts and agreements. Might be an engineer, might be a salesperson, but they're basically working on agreements. That's not their pure forte, and they're going to have some problem doing that. Now, one of the worst things you can run into, and especially when it's a member of the management team, it's the person who found the deal, who's in charge of it, and that person has fallen in love with the deal. This is never a very good idea. Objectivity really counts. I once worked on an acquisition where a senior vice president at DSE had decided he had to have this company that we were looking at, and he just had it as he could not wait to get his hands on that technology, and he beat up on us every day, get it done, get it done, get it done. Well, point of fact, we were actually brought into this process a little late because I had been on another assignment. And I was a bit curious about it, so I went ahead and before putting a full due diligence team on the ground there, I took one internal auditor and we went over that company and we spent 3 days. And every rock we turned over had something under it. First of all, this company was supposed to have 30 people in it. We could never find more than 12. Those 12 people we always found in the coffee room talking about where to send their resumes so that they could get out of the company. Finally, the internal auditor discovered that the president of the company was writing checks to his vendors and putting them in his desk. Well, that meant that the cash stayed high, which made the venture capital backers happy. It meant the books looked right because he was recording the expenses. The only people who were the wiser and sadder were the poor vendors who were not really getting paid. Now, I was faced with a bit of a problem here. If I wanted to put a stop to this acquisition, how do I handle a senior vice president who outranks me tremendously? So I thought it over and talked it over with the auditor, and we put together a relatively lengthy and probably the most boring presentation I have ever done in my life. because all we did was list all the liabilities we had found. Didn't try and dress it up at all, just list them. We got halfway through that presentation when the senior vice president bounces out of his seat and says, "Wait a minute, I don't want any part of this. If I take this on, I'm going to inherit all those liabilities and I'm going to be the one who has to clean them up? No way, forget it, deal's off." Now, funny aside to that, remember I mentioned venture capitalists? From the venture capitalist point of view, they had a deal until this guy Phillips showed up. 3 days later, they had nothing. They were not particularly pleased. They made some phone calls, some of which were a little bit litigious sounding. So I had an idea, and I went to the CFO of DSE, and I said, let's do something a little different. Let me make the same presentation to the venture capitalists. He agreed. We took out the 1 or 2 slides that were proprietary, and I went over to the venture capitalists and just started the same presentation. Made it through the presentation. At the end, they were very quiet. They thanked me for having made the presentation to them. And then the next day, they fired the president of that company. Okay, so let's talk about the impact of what we've been talking about. If management's in charge of the process, they can get mired down on it. And as I say, you're going to have a loss of focus on the core business. Obviously, that's a very expensive and difficult problem. The process is probably going to take longer. That's because it's not going to be managed as efficiently as it could be. Managing an agreement process is something that requires experience. More experience, and it will go faster and smoother. Then finally, whoever that person is who's supposed to be moving the process along, it's not their full-time job. They still have their day job, they still have other things to get done, and it's going to take longer. When it takes longer, you're going to find that the real costs are very often not adequately controlled. There's a couple of reasons for that. One, a tendency to depend more on the lawyers and perhaps the accounting firms because there's not enough time for the people in charge to work on the deal, so those fees go up. But also because as those people are moving through the process a little more slowly with more difficulty, there's more iterations. The contract goes back and forth more times. And every time it goes back and forth, the lawyer has to take a look at it again, and some of the time the accounting person, and you run up that cost, to say nothing of the internal costs. Then I've just found that many of these agreements, once they're finished, because the people were not really familiar with the process and what to do, they have too much risk in them. There are things that could have been done to mitigate risks that weren't accomplished. And finally, you run the risk of the deal not being done at all. The other side is going to pick up on what's going on. They're going to get tired of the amount of time it's taking. They might wonder, well, if they can't handle this process, what are they going to be like if we have to work with them? And they may decide to do the deal with someone else entirely. So what's our proposed solution? It's to put a qualified, objective, couch the objective person in charge of the process. That person should have some training and negotiation. I took the Chester Karras courses, found those very good. I recommend those, but there are others around as well. It'd be nice if the person had a good business background. In fact, an MBA would be nice to have, but absolutely not a necessity. But some good business sense would help. And then that person has to have credibility with and access to management. Now I'm going to go through that one again. Credibility with and access to management. Both sides of that have to be true. If you've got somebody who's got credibility, management team trusts them, but doesn't really give them access, then when that person realizes that there's a problem that needs to go to management and can't get through to them, he or she is going to have to make a decision, and that may or may not be what it is that management really wanted to happen. But the other side is true too. If they have access to management, but management doesn't really take their word for what they're hearing, then you're still going to end up with a disconnect, and that's going to end up in the final agreement. Where do you find people like this? Look in finance. You're going to find business people there, and they can be taught the contract part of it. If you have a contract department, obviously they should be able to handle the higher level things like the OEM agreements and mergers and acquisitions if you get into that as well with just a little more training. Business development people, same way. And finally, if you've got procurement people, they're very used to negotiating agreements, and they can, again, learn the higher level of agreements without too much difficulty. If there's nobody on board, you might want to consider outsourcing. Not going to put too many commercials into this webinar, but that is something Effective Agreements does. We're the people to whom you can outsource this process, and you manage us, and we manage to make sure that you get a good agreement. Okay, and then finally, if you choose somebody internally and they don't have a process in mind, make sure they get one. Again, you can call on someone like us, or you can call on other experts, and just get them to get a process down that they're going to use time after time when they're doing these kinds of agreements. That ends the first part of the seminar and the first recording. I hope if you've downloaded, you'll download the second part, and that the rest of you will stay around for the rest of the webinar. Thank you.